I've just read the Alibaba's earnings transcript, so you don't have to. All you have to do is to help smash that cute little like button on your way out. Now, I'm just gonna focus a few of the key pointers that are highlighted throughout the transcript itself that I thought would be pretty interesting for potential or even current existing Alibaba shareholders. So sit back and strap in. Just to essentially go through some of the remarks. The first part is essentially the prepared remarks by both Daniel Zhang, who's the CEO of Alibaba, and also Toby Xu, who's the CFO of Alibaba. Essentially, Daniel actually laid out the ground context of the operating environment Alibaba was in over the last 1 year or so. So despite these challenges, we delivered double-digit year-on-year growth in our adjusted EBITDA and the free cash flow through effective business management, cost optimization, and operating efficiency. So what I'd like to focus here is this very clever shift in business metric. So here he used adjusted EBITDA, not revenue, not profits, adjusted EBITDA. So for many Munger or even Buffett fans out there, they like to call adjusted EBITDA or EBITDA bullshit earnings. So for me, I'm largely in the same camp. But I think largely speaking for Alibaba specifically, revenue currently is slowing for many quarters now because of the slow economic environment and of course extremely competitive pressures from all sides. But I think one benefit of the doubt that I can give to management is really their operating efficiency and how they've been optimizing their cost structure. So you can look at their earnings presentation, which I've covered in one of my previous videos. But just looking at free cash flow and the cash generative ability of the business itself, it's actually up year on year, I think up 15%. And free cash flow, I think, is one of the most important metric that many investors look into. And spoiler alert, Alibaba still generates a huge ton of free cash flow, for those of you who are wondering. Now, with the lifting of COVID-related measures that end our peak wave, everything is now quickly getting back on track. In general, consumer confidence and business confidence are rising. This is just a narrative building of how China is opening up. We have to look into the numbers. So in order for us to triangulate this data point, we have to monitor closely in the subsequent 2 quarters in 2023. And only judging from those prospective numbers can we then make the assessment or judgment that, hey, we are finally getting back on track. Now, Daniel also said that he has chosen progress as a keyword internally to set the tone for Alibaba's development this year. So we need to respond quickly to the change in macro environment and major cycles. The theme of progress represents the need to adapt to the trends in macro environment and for Alibaba's own development. So we remain confident in our 3 main strategic pillars of consumption, cloud computing, and globalization. So during December quarter, the China consumer market was highly impacted by COVID cases. Both Taobao and Tmall GMV topped mid-single digit year-on-year, and consumption demand was greatly suppressed. In terms of category, apparels and other discretionary goods were weak, while healthcare and wellness related grew strongly. So from January to early Feb of this year, overall sales of online physical goods remain weak. So I kind of highlighted it in purple in color because it kind of contradicts his previous initial tone where they're saying that everything is now getting back on track. While he did say that because this earnings report actually came in the mid of Feb, he actually do have data coming in from January and even into mid of Feb. And he did provide the comment that overall sales of online physical goods remains weak. So like I said, we have to look into the numbers. Let's not trust too much of this narrative building of whether China reopening is going to be a net good or net bad. The numbers don't lie. Yes guys, I'm still sick, so please remember to help smash the like button. I'm sick and I'm still making Alibaba breakdown video. Anyway, in our operations, we are strengthening the user experience and our customer value proposition on Taobao and Tmall to reinforce our market leadership with the following measures. First, enhance user stickiness and time spent. Taobao and Tmall are home to China's most comprehensive population of online shoppers and is the most efficient consumer transaction platform. We are building on our competitive advantage by continuing to introduce a wide variety of consumption-related content in the form of SFV, short-form video, live streaming, and other formats to strengthen consumer stickiness, product discovery, influence, and user engagement. So I think largely speaking from a competitive landscape, yes, there are a lot of new players coming in, and I think ByteDance is a force to be reckoned with. But that said, I think Alibaba is not a new kid in the block. They've introduced many of these different product offerings like Taobao deals to fight Pinduoduo. They have their own Taobao live streaming, which is to fight all the short-form video live streaming platforms like TikTok, ByteDance, etc. So I think in many of these different business segments, Alibaba has a hand in everything. But I think the biggest concern, especially for prospective investors, is how is it going to impact margins? And clearly, margins has been severely impacted over the last 2 odd years. Initially, the entire ad architecture that Alibaba managed to build based on their consumer management revenue, CMR for short, has been an extremely high margin business. But you can see in terms of both gross and net margin, from the highs of 30 odd percent, it's slowly just titrating downwards to even 10, 15, 20%. But I think a redeeming factor is this. I mean, many of these nascent industries, specifically live streaming, short form videos, many of these companies haven't really found out a way to effectively monetize the population and specifically the shoppers and merchants alike. And similarly, I think ByteDance just turned profitable last year. So in this case, I think it takes time for many of these nascent industries to build out the entire architecture, which is why, similar to Meta platforms, they are currently in a huge reinvestment cycle. And for investors who are slightly impatient, and for those of you who cannot sit through this entire reinvestment cycle, then I don't think Alibaba is a stock to invest in. If not, for those of you who have trust in the management team in how they deploy capital, how they build out the different business segments, then sure, I think this is a pretty good opportunity, especially when valuations are essentially dirt cheap today. So now, moving on to their international commerce business. So far, all our employees in Turkey are safe. Trendyol's business operations remain stable, and they have mobilized resources to aid disasters relief. As for the data, as the business continued to optimize for order volume growth, they have also reduced loss per order by more than 30% year-on-year. We remain firmly committed to continue to invest in Lazada's region of Southeast Asia. So I think largely speaking, the theme for many of these money-losing operations are the same. They just want to optimize. From losing money to losing less money. And it's clearly seen from the earnings report itself. But I think one important factor here is, I highlighted it in blue. They say that they'll continue to invest in the Lazada's region of Southeast Asia. I think Lazada, if you to compare it to Shopee, which is Sea Limited's e-commerce business, it's still pretty lackluster. Yes, I've seen many articles saying that they're going to invest X billion dollars into this Lazada business, but the effectiveness have yet to be seen. So, moving on to cloud. The growth rate for public cloud was double digits year-on-year, which was partially offset by a decline in hybrid cloud revenue from projects delays due to COVID. So interestingly enough, public cloud segment, for many people have been saying that, hey, because of the government crackdown, people are not going to adopt all these public cloud providers, whether it's Tencent, Alibaba, or whoever. They will want to go to state-owned. But evidently, there is still growth out there. Ironically, for those of you who actually dive deeper into the numbers itself, it's the private enterprises, specifically the internet companies, that were hugely impacted by this cloud adoption because of the tech crackdown that happened or transpired over the last 2 years. So right now, I think they're just trying to balance it out. At the end of the day, private enterprises are still going to be the biggest customers for many of these cloud providers. There is a short bump in the last 1 year, but if you do believe that cloud adoption is the way to go and it's the future, then I think that we are still sitting on a huge amount of circular tailwind. Now, Alibaba also announced an important organizational change towards the end of last year. So I, who's Daniel, took on the role of acting president of Alibaba Cloud, in addition to my current role as chairman and CEO of Alibaba Group. You know somebody is getting serious when he takes over a particular position in the organization, even though he's the CEO of the group. So this decision was based on a few considerations. First, cloud computing is one of Alibaba's core strategy for the future. So innovation and other technologies will have an impact, not just as on Alibaba Cloud for the entire Alibaba Group. Second, Alibaba Cloud is also the foundation through which Alibaba serves the real economy and will continue to drive physical-digital integration. Third, we believe that this is a critical period for technological breakthrough and development in the cloud computing and AI space. So like all businesses, I think optics is extremely important. So in this move of this organizational change where Daniel is going to do a dual role of being group CEO and also the president of Ali Cloud, means that he is going to be extremely serious about this entire cloud sector. And albeit cloud growth being lackluster over the last 4-5 quarters, I look forward to how Daniel is going to bring in the strategic importance of Alibaba Cloud and how it's going to grow in the subsequent few quarters. So moving on to the interesting Q&A by Alex Yao from JP Morgan. Alex Yao, our most favorite analyst out here. So he asked management, looking forward, what do you think will be the next big area or areas where Alibaba can achieve significant growth? And how do you see Alibaba better marshalling in its core competitiveness in the short term? And will part of that involve further optimization of costs and driving operational efficiencies? So Daniel responded, indeed, over the past 20 plus years, the major opportunities for us that we've seized have been around applying digital technology to commerce, logistics, and cloud computing. Well, very simply, it's because we think that in those three areas, the ceiling is high enough and the market is big enough. So he went back to continue reiterating the three core strategies, which is consumption, cloud, and globalization. So that's more than enough for us to accomplish there, especially as we continue to evolve our technology, where we are confident that we can continue to find huge opportunities in those three core areas. And he then talked about the China's GDP numbers, whether they can maintain a 5% per annum growth rate. So if China's economy does grow by 5% a year for 10 years, you can certainly imagine that the proportion of the size of the contribution of consumption in China within GDP. So we are talking about 40 trillion today against 110 trillion. I think, Daniel, you might be a little bit too ahead of yourself. I'm saying that Alibaba is gonna 2.5 times in time to come. It might take some time. I have no doubt that as inflation comes in and as China continues to innovate and continue to prosper, we might hit the 110 trillion mark. But I think I'm more interested to know what's Alibaba's position and what's Alibaba's role in the Chinese economy. And if a second Jack Ma will come out and then the CCP will start cracking down the tech industry again. But I think largely speaking, Alex did ask a very critical question. And from Daniel's perspective, he did just reiterate the three core segments that they're focusing their time and efforts in. I'm not going to say this is a spectacular response because we were hoping for a ChatGPT or a huge AI revolution. And I think from that perspective, Daniel really didn't give a very head-on answer. Also, Daniel did take a small jab at their competitors. So we will be investing, therefore, to drive progress in new technology and to integrate new technology with businesses to create new value and new kinds of businesses with tremendous prospect going to the future. And in fact, that's what Alibaba has done over the past 20 years. We haven't been a low-price competitor. We haven't been relying on heavy subsidies. So for those of you who don't know, JD.com recently announced a huge fund, I think it was $1.5 billion, saying that they're gonna heavily subsidize many of their merchants and customers alike. And I think this response is specifically targeting at JD.com. Now, the next question is from Ronald. At what point can we expect to see positive growth returning in the GDP GMV numbers? And also, how are we going to achieve a balance between growth and investment in this new year? Because we know that there are people who engage in a lot of subsidization behavior in the markets. Seems like many analysts are very interested in understanding what is Alibaba's strategy moving forward. So Daniel replied, I did lay out a detailed and comprehensive picture as I could. January certainly was still a challenging time through the Spring Festival, which is Chinese New Year, especially when people are traveling widely in large numbers across the country. So of course, since the resumption of normalcy, if you like, it's only been a short time. It's been just about half a month, so we do need to keep our eyes on the ongoing picture that continues to develop. But certainly, we are optimistic about continued improvement in the situation. So every couple of days, somebody out there comes up with a bright idea to try to engage in heavy price subsidies in order to win more opportunities and turn around the business. But I think if you take a clear-eyed look at history, no player ever has managed to achieve that kind of turnaround by relying on price subsidies. So at the end of the day, it's really about merchants being able to provide to consumers the best products at the best prices in a way that is sustainable in the long term so that the merchants can make a return and continue to invest in a sustainable cycle. And this is the symbiotic relationship Alibaba is trying to create. So he then ended off with a very snarky remark. So as Toby said in the script, we have deep pockets with $55 billion in cash. So we can continue to leverage these approaches to create value for users and maintain our leadership in the market. I do hope that he's not going to burn 55 billion and just race to the bottom. I think largely speaking, in terms of Alibaba's ad architecture and this entire e-commerce marketplace, they've evidently been doing something clearly right, which is why they are being conferred with the leadership position for so many years now. It's true, they've been losing a lot of market share over the years, but if you're the biggest, you can only lose market share. It's the same to Google and Alphabet and Meta, where Amazon comes in, many other advertisers are chipping away at the market share. I think generally speaking, Daniel should just focus his efforts into creating value propositions for merchants and also consumers. Forget about all these heavy subsidizing antics that other competitors are using. You can continue heavily subsidizing. Just look at what Shopee has been doing. They realize that it's unsustainable. So let's just focus on value creation here. Let's not look into price war and racing to the bottom. Next, moving on to an analyst from Barclays. I'm wondering what other potential methods could be available for Alibaba to increase shareholders' value and to increase returns to shareholders. Are there any other things, for example, considering distributing dividends or further expanding the scale of the share buyback program? So Toby did say that we have a remaining quota of around 21 billion to be deployed, and I think based on the time of this recording, Alibaba is around a 210 to $230 billion market cap. So that's still 10% of the outstanding market cap that they can buy based on the share buyback program. And at this point of time, no, we are not considering further expanding the quota. So their focus here is to how best make use of the remaining quota of 21 billion, how to deploy it, and when to deploy it in line with the authorization given to us by the board of directors in order to further enhance shareholders' value. So largely speaking, I think people are not very happy about it because they're saying that, hey, you still have $55 billion in cash. You just made $11 billion in free cash flow in the last quarter. Why are you not looking towards trying to do more share buybacks or trying to give dividends? From an investor's perspective, you probably would give dividend if you have no better investment opportunities. But it does look like Daniel is placing a huge emphasis on Ali Cloud. Let's see whether he can bring Ali Cloud to greater heights. And I think more importantly for share buybacks, you have to buy back the share when it's undervalued. Don't buy back the shares when it's overvalued. Now, largely speaking, I think it's still undervalued, but I think the share repurchase program for the following 21 billion, there's still around 1 or 2 years. So I think it's not too late if in 2024, Alibaba continues to remain undervalued, they can authorize another level of share buyback program. So I think they're just trying to hedge their position here. They don't want to promise too much and then not deliver. But in 2024, if Alibaba continues trading at these sort of valuations, what's stopping them from increasing their share buyback program again? Who knows, but that's that. So another analyst from Citigroup, I'm just wondering if you could break that down for us a little bit and explain which of the business this year we can expect to see adopting a new technological innovation that leads to new business models and new opportunities that will, for example, result in accelerated CMR growth or boost cloud revenue, or will perhaps be in the local services where this breakthrough will be met. So Daniel then took a jab back at Google and Microsoft as well. But we're not talking about having a chatbot for the sake of having a chatbot. This entire idea of ChatGPT and this whole AI revolution. So the focus here, we are talking about integrating the capabilities deeply into the business around consumption, around user experience for content generation, or drive higher advertising effectiveness. And yes, I think Alibaba shouldn't be jumping on the bandwagon, and just because our competitors are doing something, then we must do something as well, even though it's a half-baked response, which is like Alphabet's but just saying. So AI can be leveraged in the ways that we talked about earlier when we talked about supply chains and local services to better match local demand with fulfillment capabilities. And I think the last question from an analyst from UBS. Looking forward, to this quarter or even the few quarters to follow, do you think we are expect to see a change in the relationship between the growth rate of GMV and CMR? And could CMR grow faster than the GMV in the next quarter? So GMV is gross merchandise value, essentially the number of products that they move on the platform. CMR is customer management revenue, which is the high margin business of Alibaba Group. So on your first question regarding the relationship on the ratio between CMR and GMV, we discussed this issue previously. And just to recap briefly, the issue of late really has been the high rate of order return due to, among other things, logistics disruption. Because when we talk about GMV, we are talking about paid GMV, which excludes the return rates. And I think for the relationship between GMV and CMR, the gap is definitely narrowing, so that's a good sign. So I think largely speaking from this earnings call, the management tone, specifically Toby and Daniel, is a lot more upbeat compared to the last 2 quarters. But that said, they did try to hedge their downside, and there's a lot of focus around CMR, which is the high margin business, and also cloud computing in this case. And given this new organizational change where Daniel is going to single-handedly go into Ali Cloud intelligence business, I look forward to how it's going to push the envelope. So with that, if you guys have any differing thoughts or opinions or comments, feel free to leave in the comment section down below as well. I'll see you in the next video, but more importantly, I will see you on the moon. Goodbye!